Okay, chapter 3 is all about preparing your taxes. And of course, this chapter needed a major revision because in December of 17, Congress passed into law and it was signed major tax reform. In fact, the most major comprehensive tax reform since 1986. So quite a bit's changed, and that's really what this chapter is going to walk us through is number one, how does taxes affect me, and a little bit about just kind of what's changed from the old tax law to the new. So clearly, any good financial planner, anybody you go to help you with your finances, one of their goals should always be to help you keep as much money in your pocket as possible by maximizing any tax deductions that legally you can take, and so by legally minimizing your tax burden. Okay, so just keep that in mind. These are always good to look at. Hopefully you've taken a few looks at these from other chapters also. I'll just let you read those on your own. And then here, so impact of income tax. Typically for most people, when you include all taxes, so this is federal and state, and keep in mind payroll taxes. So when you have a job, your employer is withholding from you 7.65% of your income as Social Security and Medicare tax. So you're paying that in, and then they're also withholding from you based on your marital status and emergency deductions, your income, a certain amount of federal income tax from your paycheck also. But when you include payroll taxes, federal income tax, state tax, sales tax, property taxes, all of that is about 1/3 of our income goes to taxes of some sort. Okay, and you can see what some of those numbers are on the screen. The tax computation is by no means complicated. It's probably what's harder is what is the tax base. So the base is, basically what is your taxable income, because there's all kinds of rules about how to come up with your taxable income. Now also keep in mind you're taxed at a different rate for your income versus dividends or capital gains. Your income has the maximum rate of 37%, depending on the bracket that you're in. Dividends and capital gains are capped at 20%. That's the most you can pay. So there's a reason to own stocks because the money you pay in your dividends is only 20%. The tax you pay in dividends is only 20%. Okay, so this is the rates for the single taxpayer, comparing the old versus the new. On the right-hand side, you can see that it's the top rate's only 37. On the other one, it was 39.6. The brackets are very different. They're not as tight. The ranges of the brackets are wider. You can see in terms of what the amounts are also. But those are some of the significant changes. Okay, so it says here, so a significant change, a taxpayer with taxable income of 36.9, for 17, your tax would have been 5,068. For 18, your tax would have been 4,237. That's 5% savings. Okay, and that was kind of the goal of the new tax law, was to reduce the federal income tax rate, make tax filing a little bit easier in terms of deductions and things like that. But that was the goal, was to reduce the tax rate also. The tax rate is progressive, meaning the more you make, the higher the percent of your income that you pay is. Okay. Now, sales taxes are flat and what they call regressive, and South Dakota is a very sales tax intensive state. Because we don't have a state income tax. Sales tax is really the biggest income source for most city and state governments, and it's the same no matter what your income is. So if your income's 100,000 or 50,000, sales tax is what it is. It's the same for everybody. They call it regressive. So your average tax rate is your total tax times divided by your taxable income. And then your marginal tax rate is the tax on the last dollar of taxable income. The average tax rate is used for long-range planning, marginal for short-term planning. So, a financial planner we kind of go through what we think your income will be for several years, and then how much, what your average taxable income will be per year to come up with your average tax you would pay. And then based on your status, your tax rates will be different also. So you have single, married filing jointly, married filing separate, head of household, and surviving spouse are the options you can choose from. Take-home pay is the net. Everybody who has a job, at some point you make your gross income. So let's just say you worked 100 hours during your pay period, and you were paid $10 an hour. Your gross pay would be $1,000. Well, we all know you're not going to walk away with $1,000. That when you are paid, you'll be paid an amount less than that because your employer has taken out for sure Social Security and Medicare, which is 7.65%, plus some federal income tax withholding if you're using your employer to pay for life insurance or health insurance or retirement. That was also taken out, so that then basically you get down to your net pay after that. And then remember I mentioned capital gains earlier. Long-term capital gain is you own the property for more than a year. Short-term was any amount less than 1 year. For long-term gains, you're capped at 20%. Okay, so it says right here, long-term capital gains. All we do is look at what is your tax bracket? What bracket are you in? If you're in the 10 to 12% bracket, you pay zero long-term capital gain tax. The vast majority of Americans will be in this middle one, the 22 to 35. More than 50% of Americans will be in this bracket, in this range here. You pay 15%, and the upper amounts will pay 20%. Short term, you pay the same tax as any income, as any ordinary income. Think of your paycheck income, stuff like that. Okay, so if you're in the 37% tax bracket and you have a short-term capital gain, you'll pay 37% tax on that capital gain. Unless it's long-term, then you pay 20%. Okay, so just keep that in mind. There'll be questions in your homework about that. And then with dividends, again, has to be from a U.S. corporation, taxed at the long-term capital gain rate. So any dividend by owning a stock that you receive, basically we figure out what bracket you're in, one of these three down here, and you pay your dividend tax based on that bracket that you're in. Now for capital losses, they are deductible. You can deduct up to $3,000 per year of capital losses. So if you have a $50,000 capital loss, it'll take 17 years to offset that unless you have capital gains. Then you can just match them right against capital gains. And corporations, this is not a corporate tax class by any means, but corporations themselves cannot deduct capital losses. There's three kinds of income. Active income, that's from you working for the most part. If you're self-employed, working for somebody else, working for a company, that's your active income. Your portfolio income is income from investments. Okay, and then also, if you have investment interest, if you borrowed money to buy investments, that's deductible. Also, you can deduct that. And then passive income, income from property not related to personal services of the taxpayer. Loss from one passive investment may only be deductible against income from another passive investment, not deductible from active income. So there's kind of three different types of income to be concerned about. Most people will mostly have active income. Depending on if you are investing on your own, you might have some portfolio income. Not a lot of people have passive income though. So taxable income is your gross income. Just kind of think money from your employer. And then anything else. So if you receive life insurance proceeds, scholarships, gifts, interest on state and local bonds and other, you subtract from that adjustments, which is your deductions that you're allowed to take. Contributions to retirement funds is a deduction. Income, personal interest paid on a primary residence, property taxes, certain sales taxes, any deductions. Then we get down to our AGI, or adjusted gross income, and that's really what we care about, because that's what determines what our tax bracket is. So taxable income minus deductions to get down to the AGI, adjusted gross income, and we multiply the tax bracket amount, whatever that rate is, times the AGI. Now, one of the things about the new tax law is they upped the amount of the standard deduction. So it used to be, it was kind of low, and so a lot of people could itemize. But now, because they upped it so much, the estimate for 18, and of course 18 is just getting done, and so we're not going to really know the exact stats for a while, but the estimate is about 90% of taxpayers will claim the standard deduction. And that's a big increase from what it used to be. It was 67%, now it'll be 90%, because they raised the amount of the standard deduction by so much. But what goes into your deductions would be, again, just some common ones: interest on your home, property tax on your home, sales taxes. A big one is charitable gifts. So if you're giving money to a church, to a qualified charity, that also contributes to deductions. Okay. And standard deductions, the amounts of what those are, you can see here how much it changed by. $6,350 to $12,000, almost doubled for a single taxpayer. It almost doubled for married filing jointly. And if you're over 65, it's actually even a little bit higher. And then it'll change every year based on what they call the consumer price index. Basically, as inflation goes up, then these amounts will go up by the same amount. And more things about itemized deductions. Medical expenses is one I didn't mention. I mentioned state taxes, but only property and either income or sales tax. So like in South Dakota, we don't have a state income tax, but we do have sales tax. So you are allowed to take a deduction for sales tax in South Dakota. Interest on your up to 2 personal residences, but they have to be something that you live in. If you don't live in it, if you're renting it out to somebody else, you don't get the deduction then. Charitable contributions I mentioned, and then a few miscellaneous ones also. And part of what Congress did is they kind of tightened these up. They're not as easy to make as they used to be, primarily because they upped this so much. They kind of just felt like it's easier for the taxpayer if the standard deduction is just much higher. That made more sense, as opposed to having a bazillion laws for all these different little itemized deductions. So for charitable deductions, though, 2 options are available. Make contribution to charitable trust managed by investment fund with payout directly to by the contributing taxpayer. If you're over 70 and a half, you can direct IRA money to a qualified charitable distribution directly from your IRA fund to the charity. So some deductions that were taken away, and this tax law has a 7-year window for some of these rules, by the way, 18 to 25. Casualty losses, basically if you've got some kind of a loss due to a fire, car accident, something happened that cost you a loss. Moving expenses, entertainment, amusement, recreation. The miscellaneous itemized, kind of most of those went away. Alimony is not deductible, so they took a lot of those away in exchange for just upping the standard deduction anyway. Now, of course, this is not a business tax class, but if anybody's thinking of starting a business or maybe currently has their own business, there's business tax deductions also that we have to think through. An LLC or a partnership is what they call a pass-through entity. LLC means limited liability company. And what that means is the business itself does not pay tax. Instead, you compute, how did the business do? If the business made money, then that the net income from that business then goes to the owner's personal tax return. And so if you have your own business that was profitable and made money, you get what they call a QBI, qualified business income. That's what they call that. It's 20% deduction with some rules or some limitations. But basically what that means is if you have your own business, 20% of that income from your business may be deductible. And that's brand new with the new tax law. Business interest is limited to the sum of business interest income, or 30% of your adjustable tax income. There's some depreciation rules and so on. But that's just some little things to just kind of keep in the back of your brain. Primarily, we're going to focus on more individual stuff. And then a tax credit is a dollar for dollar reduction in your tax. So if you have a $1 tax credit, that reduces right off the top on your tax bill, how much tax you have to pay. So let's just say your tax bill is $8,000, but you've got a $2,000 tax credit. Well, you just took $2,000 off that, and now you only owe $6,000. But some common credits are right here, child tax credit. So for every dependent child you have a $2,000 tax credit. Qualifying dependent, not qualifying as a child, is a $500 credit. So let's just say you are basically a parent of yours is dependent on you, your primary caregiver for a parent. Educational credits, residential energy credits, dependent care credits if you're paying for daycare, earned income credit is a few other ones like that too. Earned income is if you're in a lower tax bracket, you get what they call the earned income credit. And basically what that means is you get a refund even if you didn't have enough taxable income to pay tax. If you fall under the earned income credit, then typically you get money back no matter what. So some credits are refundable, some are not. You can see here what a few of these are. If you only have $1,400 of a $2,000 child tax credit is refundable, and the $500 credit for a qualifying dependent is not qualifying as a child is not deducted. It's non-refundable. So it doesn't mean it's 100% refundable, but at least it does dollar for dollar reduce your tax bill. So taxes are typically pay as you go. With every paycheck that you have, money's taken out. The employer is required to withhold income tax as you are paid your salary. Of course, then that helps to make sure that you're not falling behind on paying your taxes. Banks and other financial institutions must withhold tax from amounts they pay to taxpayers. So let's just say that you have some kind of a settlement or you get money from an investment. They have to take a certain amount of that away from you before they remit you the net amount. Self-employed taxpayers must at least pay quarterly taxes to make sure they're not falling behind and not kind of keeping up with what they owe at the end of the year. Your tax refund is anything that withheld, basically divided by your tax refund is tax owed less that should be minus tax paid. Tax withheld minus tax paid. So tax forms, the form in 2018, the form 1040, it's about a half page front and back. There are 6 schedules that you could attach to it. Most people use some kind of software, TurboTax, TaxAct. A lot of it's free. If you have a very simple tax return, a lot of it's just free or very inexpensive to buy. You can just do it online. That's very common. You can see here the new tax return. It's much different than what it used to be. It's much simpler, and again, it kind of mentions kind of like a half page. It almost looks like a postcard the way it's shaped now. It used to be very different, more up and down and narrow. Now it's kind of more like this. So this basically 2 pages front and back, kind of like a postcard, and this is where you put in the front kind of your personal info, single deductions, things like that, address, all that good stuff. On the back then is your wages. And then you get down to your deductions, your AGI, and then your payments, and then what you have to either pay in or get refunded back. And then we have all these schedules to add. So depending on your tax situation, you may have schedules to attach. You may not. It just depends. So obviously there's many tax preparers. We'll start to see those commercials in January. You'll see a lot of them, but you can see what some examples are. Okay, and then tax planning is just basically saying, what will your income be, and then how can we employ legal strategies to minimize the amount of tax paid. If you have interest from state or local bonds, for example, it's never taxed. So maybe if you're in a high income bracket, quite often it makes more sense to buy state or local bonds because that interest income is never taxed. I can earn that tax-free. Dividends are the maximum amount I pay in dividends for taxes is 20%. On interest, though, is treated as if it's ordinary income, so that could be up to 37%, stuff like that. So if I own preferred stocks and receive dividends, I pay lower taxes than if I'm in receiving interest for bonds, depending on what my tax bracket is. And tax shelters are just a way to park money and then not have to pay tax on it to some degree, at least defer it or not pay it at all, depending on what kind of investment it is. In a tax audit, of course, the IRS would just say, if they, think something's fishy with your return, they could definitely do something about that. Let you know, do an audit, whatever that would be. They have 7 years, so when you file, there's a 7-year window where they could look at that. It's pretty rare they go back 7 years, though. Okay, but anyway, just keep in mind that the tax law is very different than it was. So if you knew anything about taxes before this class, just kind of be aware of the fact that it's not quite the same. The general concepts are the same, but it's not exactly the same as it used to be.